It wasn't all that long ago that traditional players like GM, Ford, and General Electric dominated the industry landscape, but no longer. Now it's tech companies like Amazon, Google, Apple, and Facebook that are leading the way. But is today's Google at risk of becoming tomorrow's GE? Vitali Mossounov is a technology analyst at TD Asset Management. Vitali, thanks for being on the show today.
Great to be here.
From a technological perspective, can you give us an overview of what's happened to the world over the past 2 decades?
Well, I probably don't need to tell your viewers exactly how things have changed. I mean, we're living and we're breathing these changes every single day. For example, innovations like ride sharing, e-commerce, social media, these have profoundly changed the way that we look for transport, the way we spend our money, and the way we dedicate our leisure time. But the really important question is to ask why. Why are these things suddenly possible? What are the enabling technologies that are allowing us to do this now?
And can you highlight some of those technologies?
Absolutely. I'll point to 3. The first one might not be as obvious, but it's semiconductors. And these are the microchips inside of electronics and other devices. Now, these continue to get better and better, faster and faster. And the implication of that is that all of the computers and devices that we have with us, these are gaining more and more capabilities. The second thing is the internet. The internet, of course, was around in 1998, but it was in its infancy. Only 3% of the world's population was online, virtually all of them in the developed world. Today, over half of the global population is online, and the majority of users are actually in emerging market economies. And finally, smartphones. Smartphones have allowed us to take this expansive digital world away from a fixed space like a desk to go anywhere on the go. So, for example, we can now spend every waking moment interacting with different services that companies provide to us digitally, rather just at a fixed location.
Now, I think you brought us a very interesting chart with you today. Can you kind of walk us through this from an investor perspective?
Absolutely. So I think as good as we all are as sensing change, sometimes the market is best at illuminating some of the shifts that are really happening. This chart is rather simple, but it's also profound. What we see here are the top 10 companies, the top 10 public companies by market capitalization. The most valuable companies as of the end of 1998 and the most valuable companies as of the end of 2018. That's a 20-year time horizon. And I think as you scan that chart, there's 2 things that really jump out at you. The first is that the list has changed a lot. For example, only 2 of the companies on the list in 1998 remain at the top in 2018.
Interesting.
And that suggests that we, as consumers and as businesses, are procuring products and services from a different list of companies. Now, the second take is that technology companies, they've become a lot more prominent. There were 4 of them on the list in 1998. Today, there are actually 6 of them, and they occupy the top 4 slots. Probably this insight might not be surprising to many of us, given just how much we interact with some of the aforementioned products and services.
Are today's companies doing enough to stay on top?
We decided to look at who are the companies that are making productive investments today so that they can remain successful companies tomorrow. As an example, we looked at 2 buckets: research and development spending, that is, who's innovating, who's developing, and CapEx. In other words, who's building that infrastructure that will allow their business to continue to grow. The conclusions we derived were rather interesting. We found that the top 6 companies in the market today who are spending money on these productive investments, as we call them, are all technology companies. Not only that, but these technology companies are making staggering amounts of investments. Those 6 companies on the list made about $200 billion in R&D and CapEx investments last year, a massive number. To put that into context, that is roughly the same as the bottom 3/4 of the S&P 500. Remember, the S&P 500 are large American companies, the biggest of the baddest. Yeah. That's right. So the amount of investment that tech companies are making today is rather staggering. It's not just about how much you invest. Those investments need to be prudent, and we need management to be good stewards of shareholder capital. So there's a couple of ways we can look at this. First, we can examine growth. Companies are investing a lot, but are they growing out of those investments? Now, looking at those technology companies we just saw in the chart, we find that in 2018, they grew their sales about 22%. More importantly, they grew their earnings by 28%. Those are very impressive numbers that are better than the overall market. And secondly, return on invested capital. What this means is we can ask ourselves, for every dollar that the company sinks into the business, how much more can it get out of the business in profits? And what we found is that on a rolling 3-year basis, technology companies are generating about a 14% return on invested capital. Given those heavy level of investments, that's a pretty good number. And it's encouraging for investors that those management teams are doing wise things with their money.
So that paints a good picture, but what about the disruption of new technologies?
When we think about trends that are likely to change the world over the next 10 years, things like artificial intelligence, industrial automation,
Cloud services.
Absolutely.
Yeah.
There's many of these things happening. And when we examine who the emerging leaders are, it's often those same companies that are making those big investments, which of course bodes well for their sustainability as far as staying leaders going forward. And we think this is actually a shift from how traditionally we've looked at things, because historically it's been specific industry leaders that have been driving the change in their respective industries. But today technology is capturing a bigger piece of the pie. For example, it's no longer obvious to us that Ford would be the leader in autonomous driving when that emerges and becomes mature. It could very well be Uber, or it could very well be Alphabet. Similarly in retail, will it be Walmart or will it be Amazon that's going to be driving the changes and the innovations in what we buy and how we buy things? Technology companies are capturing a bigger piece of the pie, and those traditional companies are going to need to partner with technology companies to keep up. So it's really a win-win for the technology sector.
Vitali, thank you for joining us.
Thank you.